Most traders assume that failure comes from not having the right strategy, not knowing technical analysis, or missing out on secret market indicators. They believe that if they just learn one more trading technique, watch another YouTube tutorial, or buy the latest trading software, they will finally crack the code to success. But in reality, the biggest reason traders fail has nothing to do with their strategy. It has everything to do with their psychology. The stock market, Forex, crypto, or any other trading environment is not just about numbers and charts. It's a mental game, a test of discipline, emotional control, and the ability to stick to a plan even when emotions scream otherwise. Many traders enter the market with a solid technical strategy, but as soon as they see a trade move against them, fear kicks in. They panic, close trades too early, or worse, refuse to cut their losses and let them spiral out of control. On the flip side, when a trade is going well, greed takes over. Instead of following their exit plan, they hold on too long, hoping to squeeze out a little more profit, only to watch the market reverse against them. No trading strategy, no matter how advanced, can work if the trader behind it lacks the mental toughness to execute it correctly. Emotions cloud judgment, making traders abandon their strategies in the heat of the moment. A strategy that worked perfectly in a demo account suddenly becomes a disaster when real money is on the line. This is because in a demo environment, there is no fear of loss or greed for more profits. But when real money is involved, emotions take over, and that is where most traders fail. Trading is one of the few professions where being smart doesn't guarantee success. Some of the most intelligent people in the world fail at trading, not because they lack knowledge, but because they lack emotional discipline. They overanalyze, second-guess themselves, and struggle with self-doubt. They get caught in the endless cycle of tweaking their strategy instead of fixing their mindset. The truth is, the best strategy in the world won't work if a trader can't follow it consistently. Another reason psychology plays a bigger role than strategy is that every trader will face losing streaks. No matter how good the system, there will be days, weeks, or even months when trades don't go as planned. Traders who don't have the right mindset will give up, switch to a new strategy, or take reckless risks to recover losses. On the other hand, traders who understand the mental game accept losses as part of the process and stay focused on the bigger picture. Fear and greed are not the only psychological traps. Overconfidence is another major reason traders fail. After a few wins, many traders feel invincible. They increase their position sizes, take unnecessary risks, and ignore risk management rules. They assume they have mastered the market, only to experience a major loss that wipes out their previous gains. A disciplined trader, however, stays humble regardless of wins or losses, understanding that the market is unpredictable and that managing risk is more important than chasing profits. Patience is another crucial psychological factor that separates successful traders from those who fail. The market doesn't move on anyone's schedule. Many traders feel the need to always be in a trade, fearing they might miss out on opportunities. This impatience leads to poor entries, overtrading, and unnecessary losses. The best traders wait for high probability setups, even if it means sitting on the sidelines for hours or even days. The reason why trading psychology is more important than strategy is simple. Markets change, strategies evolve, but human emotions remain constant. The same fear and greed that affected traders 100 years ago still affect traders today. Those who learn to control their emotions, stay disciplined, and follow their plans consistently will always have an edge over those who don't. Tony Robbins has spent decades teaching people about the power of mindset, and in trading, this principle is more relevant than ever. While most traders focus on technical analysis, indicators, and market patterns, the reality is that mindset is the foundation that determines success or failure. The way a trader thinks, reacts, and controls their emotions plays a bigger role in their long-term success than any strategy or system ever could. The financial markets are unpredictable, and every trader, no matter how experienced, will face losses. However, the difference between successful traders and those who fail lies in how they handle those losses. A trader with a strong mindset understands that losses are part of the game and does not allow emotions to dictate their next move. They stick to their plan, analyze mistakes objectively, and adjust their approach without panic. On the other hand, traders with a weak mindset often spiral into fear, doubt, and frustration after a few losing trades. This emotional reaction leads them to abandon their strategy, take impulsive trades, or over-leverage in an attempt to recover losses quickly, which only results in even greater failure. Confidence is another key component of mindset that affects trading performance. Traders who lack confidence hesitate to take good trades, second-guess their decisions, or exit positions too early. This hesitation stems from fear of being wrong, fear of losing money, or fear of missing out on potential profits. Without confidence, even the best strategy is useless because the trader will not execute it properly. Successful traders, on the other hand, trust their system, make decisions decisively, and accept the outcomes, whether good or bad, knowing that over time their edge will play out in their favor. Discipline is another mental trait that separates winners from losers in trading. The ability to follow a set of predefined rules, even when emotions push for a different action, is what keeps traders consistent. Many traders enter the market with a plan but abandon it the moment they see price moving unexpectedly. They move stop losses, take profits too early, or chase trades that don't fit their strategy. This lack of discipline leads to inconsistent results and ultimately failure. Traders with a strong mindset, however, stay committed to their rules. Understanding that discipline is what leads to long-term profitability, resilience is crucial in an environment where losses are inevitable. Every trader, even professionals, experiences periods of drawdowns where nothing seems to work. Those with a weak mindset give up, blaming the market or looking for a new system, hoping that the next strategy will be the one that never loses. The reality is that no such system exists. Traders with a strong mindset understand this and keep going, knowing that setbacks are temporary and that consistency is what leads to success. The ability to control emotions is what allows traders to make rational decisions instead of emotional ones. When a trader lets greed take over, they hold on to winning trades too long, refusing to lock in profits only to watch them reverse. When fear takes over, they exit trades too early or hesitate to enter a setup that meets all their criteria. The market thrives on taking advantage of emotional traders, which is why those who can remain emotionally neutral have a significant advantage. Developing the right mindset for trading takes time and effort. It requires self-awareness, the ability to reflect on mistakes without self-judgment, and the willingness to stick to a plan even when it feels uncomfortable. The best traders don't just work on their strategies, they work on their psychology every day, knowing that their mindset is the real key to long-term success. The more a trader focuses on mastering their emotions, building discipline, and strengthening their mental resilience, the better their trading results will be. Fear and greed are the two most powerful emotions that control human behavior, and in trading, they are responsible for the downfall of most traders. These emotions influence decision-making, often leading traders to act irrationally, even when they know better. The market thrives on exploiting these emotional weaknesses, taking money from those who let fear and greed dictate their actions and rewarding those who have learned to master their emotions. Fear manifests in several ways in trading. One of the most common is the fear of loss, which prevents traders from taking trades even when all their criteria are met. They hesitate, second-guess their strategy, and often miss profitable opportunities because they are too focused on the possibility of being wrong. This hesitation leads to frustration as traders watch their analysis play out perfectly but fail to capitalize on it. Fear also causes traders to exit trades too early, locking in small profits instead of letting the trade reach its full potential. They fear the market reversing against them, so they close positions prematurely, missing out on bigger gains. Another way fear affects traders is during losing streaks. When a trader experiences multiple losses in a row, they start doubting their system and abilities. Instead of remaining disciplined, they may stop trading altogether, switch to a new strategy, or take impulsive trades out of desperation to recover losses. This reactive approach leads to even worse results, creating a cycle of fear-driven decision-making that erodes confidence and consistency. Fear makes traders focus on avoiding losses rather than executing their plan correctly, which ultimately leads to failure. Greed, on the other hand, causes traders to take unnecessary risks in pursuit of bigger profits. After a few winning trades, a trader may start feeling overconfident, believing they have mastered the market. This overconfidence leads to increasing position sizes beyond what their risk management allows, exposing them to excessive losses. Greed also makes traders hold onto winning trades longer than they should, hoping for even greater profits. Instead of following their exit plan, they keep waiting for the market to move further in their favor, only to watch it reverse and take back most or all of their gains. Greed also drives traders to overtrade, constantly looking for new opportunities even when the market conditions are not favorable. Instead of waiting for high probability setups, they jump into trades out of impatience and the desire to make more money quickly. Overtrading not only leads to unnecessary losses, but also increases emotional exhaustion, making it harder to stay disciplined. Both fear and greed are rooted in a lack of control. When traders let these emotions dictate their actions, they abandon their strategies, make impulsive decisions, and fail to manage risk properly. The best traders understand that success is not about eliminating these emotions, but about controlling them. They follow their plans regardless of how they feel, executing trades based on logic rather than impulse. They accept that losses are part of the process and that no single trade defines their success. They stick to their risk management rules, ensuring that no single mistake can wipe them out. The market is a psychological battlefield where emotions separate winners from losers. The traders who can master their emotions gain an edge over those who are constantly controlled by fear and greed. The ability to remain calm under pressure, execute trades with confidence, and follow a disciplined approach is what separates professional traders from amateurs. The key to overcoming these emotional traps is developing self-awareness, practicing emotional discipline, and continuously refining one's mental approach to trading. Those who can do this will not only survive in the markets, but thrive in them. Discipline is the foundation of success in trading, yet it is one of the hardest qualities for traders to develop. Most traders enter the market with a plan, but when emotions take over, they abandon their strategy and make impulsive decisions. The ability to remain consistent, follow rules, and execute trades based on logic rather than emotion is what separates professionals from those who struggle. Without discipline, even the best trading strategy will fail because a trader will not follow it correctly. One of the biggest reasons traders lack discipline is impatience. Many traders want to be in the market at all times, feeling like they are missing out if they are not constantly trading. This leads to taking low-quality setups, overtrading, and increasing risk beyond what their account can handle. Instead of waiting for high-probability trades, they force trades that do not meet their criteria, hoping for quick profits. This impatience often results in unnecessary losses and frustration. Another reason discipline is difficult to maintain is the emotional roller coaster that comes with wins and losses. When a trader experiences a winning streak, they may feel overconfident and start ignoring their risk management rules, increasing position sizes, and taking reckless trades. When they experience losses, they may panic, hesitate to take the next trade, or exit positions too early to avoid further losses. This inconsistency leads to poor performance and prevents traders from achieving long-term success. Discipline in trading is not just about following a strategy, it is about having a structured routine. Successful traders have a trading plan that outlines their entry and exit rules, risk management, and trade management process. They do not make decisions based on emotions or gut feelings. They rely on a proven process that keeps them grounded. This structured approach ensures that they do not let fear or greed interfere with their decision-making. Risk management is one of the most important aspects of discipline. Many traders fail because they risk too much on a single trade, hoping for a big win. When the trade goes against them, they suffer a significant loss that affects their confidence and ability to trade effectively. Disciplined traders, on the other hand, always stick to their risk parameters, never risking more than a small percentage of their account on any given trade. This allows them to survive losing streaks and stay in the game long enough to see their edge play out over time. Another key aspect of discipline is emotional control. The market is unpredictable, and there will always be times when a trader faces unexpected losses or missed opportunities. Those who lack discipline will react emotionally, making impulsive decisions that lead to further mistakes. Traders who have developed discipline accept that losses are a natural part of the process and do not let them affect their mindset. They remain calm and focused, executing trades based on their plan rather than emotions. Developing discipline requires self-awareness and practice. Traders need to recognize their weaknesses and work on improving them. This means keeping a trading journal, analyzing mistakes, and identifying patterns of emotional trading. By reviewing their past trades, traders can see where they lack discipline and make adjustments to improve their performance. Over time, this process helps build better habits and strengthens their ability to stay consistent. The market rewards those who can remain disciplined even when things do not go as expected. It is easy to follow a plan when trades are going well, but true discipline is tested during difficult times. The best traders understand that success is not about making money fast, it is about following a process consistently over time. Those who can master discipline will find themselves ahead of the majority, while those who lack it will continue to struggle with inconsistency and emotional decision-making. Risk management is the most critical factor in trading success, yet it is often overlooked by traders who focus only on strategies and technical analysis. Without proper risk management, even the best trading strategy will eventually fail. Many traders make the mistake of prioritizing profits over protecting their capital, leading them to take excessive risks that wipe out their accounts. Successful traders understand that managing risk is more important than maximizing gains, because survival in the market is the key to long-term success. One of the biggest reasons traders fail is that they risk too much on a single trade. The excitement of potential profits makes them ignore risk and over-leverage their positions. When the trade moves against them, they suffer losses so large that they are unable to recover. A disciplined trader, on the other hand, limits their risk on each trade to a small percentage of their account, ensuring that no single loss can significantly impact their capital. This approach allows them to survive losing streaks and continue trading with confidence. Another common mistake traders make is not using stop losses properly. Some traders avoid stop losses altogether because they do not want to be taken out of a trade prematurely. Others set their stop losses too tight, only to get stopped out before the market moves in their favor. A well-placed stop loss is essential for protecting capital while allowing the trade enough room to develop. It is not about avoiding losses entirely, but about keeping losses small and manageable. Emotional decision-making often leads traders to violate risk management rules. When faced with a losing trade, many traders refuse to accept the loss and move their stop loss further away, hoping that the market will reverse. This only increases their losses and exposes them to unnecessary risk. Others try to recover quickly by doubling down on their next trade, which often results in even greater losses. Professional traders, however, accept losses as part of the process and do not let emotions influence their decisions. They follow their risk management rules consistently, knowing that no single trade should ever put their account in jeopardy. Diversification is another aspect of risk management that traders often ignore. Placing all capital into one trade, one asset, or one strategy exposes a trader to unnecessary risk. A well-diversified portfolio reduces the impact of a single bad trade or market movement. Even within a single market, spreading risk across multiple trades instead of going all in on one setup helps protect capital and ensures sustainability. Position sizing plays a crucial role in risk management. Many traders take random position sizes based on emotions rather than a calculated approach. Professional traders determine their position sizes based on account size, risk tolerance, and market conditions. They adjust their trade sizes to ensure that they never risk more than they can afford to lose. This disciplined approach prevents emotional trading and keeps them in control of their risk exposure. Understanding probability and risk to reward ratios is also essential. Many traders focus only on winning trades without considering the bigger picture. Even a strategy with a lower win rate can be profitable if the risk to reward ratio is favorable. Traders who consistently risk $1 to make $3 can afford to lose more trades than they win and still be profitable in the long run. Those who risk large amounts for small gains eventually find themselves in a position where one loss erases multiple wins. The market is unpredictable and no strategy can guarantee success on every trade. This is why risk management is the foundation of long-term profitability. Traders who master risk management understand that their primary goal is not to win every trade, but to protect their capital so they can continue trading. Those who fail to manage risk eventually face the reality of losing everything, while those who prioritize risk control build the consistency needed for lasting success. Trading is a long-term game, but most traders approach it with a short-term mindset. Many enter the market expecting to make quick money, treating trading like a lottery instead of a skill that requires time and effort to master. This short-term mentality leads to impatience, poor decision-making, and ultimately failure. Successful traders, however, understand that consistency over time is what separates them from the majority. They focus on the bigger picture rather than chasing immediate results. One of the biggest mistakes traders make is expecting instant success. They see stories of traders making huge profits overnight and believe they can do the same. This mindset causes them to take excessive risks, ignore proper strategy development, and become frustrated when they do not see immediate results. The reality is that trading is a skill like any other profession. It takes years of learning, practice, and refining techniques to achieve consistent profitability. Those who treat trading as a long-term journey focus on building their skills and improving step by step instead of looking for shortcuts. Patience is one of the most important traits a trader must develop. The market does not always provide opportunities, and forcing trades often leads to losses. Many traders feel the need to be constantly active, believing that the more they trade, the more money they will make. This overtrading mentality results in unnecessary risks and poor decision-making. Successful traders know when to wait for the right setup, understanding that sometimes the best trade is no trade at all. They follow their plan and only take trades that align with their strategy, even if it means sitting on the sidelines for extended periods. Long-term success in trading requires a shift in mindset from focusing on individual trades to focusing on overall performance. Many traders judge their success based on a single trade, feeling confident after a win and discouraged after a loss. This emotional reaction leads to inconsistent behavior, making them abandon their strategy when faced with temporary setbacks. Professionals, however, do not let one trade define their success. They understand that losses are part of the process and focus on executing their strategy correctly over hundreds of trades. They evaluate their performance based on discipline, consistency, and adherence to their trading plan rather than short-term results. Risk management plays a crucial role in sustaining long-term profitability. Traders who approach the market with a short-term mindset often risk too much on a single trade, hoping for fast profits. When things go wrong, they suffer heavy losses that are difficult to recover from. Those who think long-term always prioritize risk management, ensuring that they can survive losing streaks and continue trading. They understand that their goal is not to win every trade, but to protect their capital and allow their edge to play out over time. Adaptability is another key factor in long-term success. Markets change, and strategies that work today may not work in the future. Traders who have a short-term mindset resist adapting, clinging to outdated strategies instead of learning and evolving. Those who think long-term continuously improve their skills, study market trends, and refine their approach to stay ahead. They embrace change and are always looking for ways to improve, knowing that trading is an ongoing learning process. Emotional control is essential for maintaining a long-term perspective. Traders who focus only on short-term results are more likely to let emotions dictate their decisions. They panic when trades go against them, chase the market after missing an opportunity, and make impulsive moves that lead to losses. Professionals remain calm and composed, making decisions based on logic rather than emotion. They trust their process and stay committed to their plan, knowing that consistency over time is what leads to real success. The traders who succeed are those who approach trading as a marathon, not a sprint. They understand that the market will always be there and that sustainable growth is more important than fast profits. Instead of chasing short-term gains, they focus on long-term progress, discipline, and continuous improvement. They build habits that lead to consistent success, while those who seek quick money often find themselves burning out or losing everything. The real key to trading success is patience, risk control, and the ability to stay focused on the bigger picture. Emotional control is one of the most important skills a trader can develop, yet it is also one of the most difficult to master. The market is designed to take advantage of emotional reactions, exploiting fear, greed, frustration, and overconfidence to separate undisciplined traders from their money. Those who fail to control their emotions make impulsive decisions, abandon their strategies, and ultimately suffer losses that could have been avoided. Successful traders understand that emotions will always be present, but they learn how to manage them instead of letting them dictate their actions. Fear is one of the most common emotions that affects traders. The fear of losing money causes hesitation, making traders avoid taking setups even when they align with their strategy. They second-guess themselves, wait for more confirmation, or exit trades too early out of anxiety. This lack of confidence prevents them from executing their plan effectively. Fear also causes traders to hold on to losing trades longer than they should, hoping that the market will reverse in their favor. Instead of cutting losses and moving on, they watch their accounts suffer unnecessary damage because they are afraid to accept defeat. Greed is another emotion that leads traders to make costly mistakes. When traders experience a series of winning trades, they often become overconfident, believing that they have figured out the market. This overconfidence makes them take bigger risks, increase their position sizes, and trade recklessly. Instead of following their plan, they chase profits, leading to poor decision-making. Greed also makes traders hold on to winning trades longer than they should, hoping for even more profits. Instead of locking in gains according to their exit strategy, they refuse to close the trade, only to watch the market reverse and take back everything they made. Frustration often arises after a losing streak. Traders who experience multiple losses in a row start questioning their strategy and their abilities. This frustration leads them to make irrational decisions, such as revenge trading, where they take impulsive trades just to recover losses. Instead of analyzing what went wrong and making calculated adjustments, they act out of desperation, which usually results in even more losses. Those who cannot control frustration often find themselves trapped in a cycle of emotional trading where they abandon discipline in pursuit of quick recovery. Patience is a critical component of emotional control. Many traders struggle with impatience, feeling the need to be in the market at all times. They take trades that do not meet their criteria simply because they do not want to miss out on potential opportunities. This impulsive behavior leads to unnecessary losses and inconsistency. Professional traders, however, understand that patience is key. They wait for high probability setups and do not let boredom or fear of missing out push them into low quality trades. They know that the best opportunities come to those who are willing to wait. The ability to remain emotionally detached from individual trades is what allows traders to stay consistent. Every trade has an uncertain outcome, and even the best setups can fail. Traders who become emotionally attached to trades react irrationally when things do not go as expected. They move stop losses, adjust targets randomly, and ignore their rules. Successful traders, on the other hand, treat each trade as just one of many. They follow their plan, accept losses without emotional reactions, and focus on long-term consistency rather than short-term results. Developing emotional control requires self-awareness and discipline. Traders must recognize when emotions are influencing their decisions and take steps to regain focus. This can be achieved through maintaining a trading journal, practicing mindfulness, and setting strict rules for risk management. The ability to stay calm under pressure, stick to a strategy, and make logical decisions even in the face of uncertainty is what separates winning traders from those who fail. The market will always test emotional strength, but those who can master their emotions will have a significant advantage over those who cannot. Many traders fail because they focus too much on finding the perfect strategy instead of understanding the deeper aspects of trading success. They constantly jump from one system to another, believing that a better strategy will fix their problems. This search for the holy grail of trading keeps them in a cycle of frustration because they never stick with one approach long enough to master it. Successful traders, on the other hand, understand that no strategy works all the time, and that consistency, discipline, and risk management are far more important than any specific setup or indicator. One of the biggest mistakes traders make is blaming their strategy for their losses instead of examining their own behavior. They believe that if they just find the right combination of indicators or the perfect entry signal, they will start making money consistently. However, even the best strategy will fail if it is not executed properly. Traders who lack discipline, emotional control, or risk management will always struggle, no matter what system they use. Instead of constantly switching strategies, they should focus on refining their execution and improving their psychological approach to trading. Market conditions are always changing, and no strategy can work in every environment. A setup that performs well in a trending market may fail in a choppy or range-bound market. Traders who rely too heavily on one approach without adapting to different conditions often find themselves stuck when the market shifts. Professional traders understand that flexibility is key. They develop a deep understanding of price action, market structure, and trading psychology so they can adjust their strategy when necessary instead of abandoning it completely. Another reason traders fail is that they do not give their strategy enough time to prove itself. Many traders experience a few losses and immediately assume that their system is broken. They move on to another strategy, only to repeat the same pattern when the next method does not produce instant success. What they fail to realize is that every strategy has losing streaks, and short-term results are not a reflection of long-term viability. Professional traders have confidence in their system because they have tested it extensively and understand its probabilities. They know that losing trades are just part of the process and do not let temporary setbacks shake their belief in their approach. Risk management plays a major role in whether a strategy is successful or not. Many traders believe that if they just find the right entry signal, they will always make money. However, entries are only a small part of trading success. Managing risk, setting proper stop losses, and using correct position sizing are what determine long-term profitability. A trader with a mediocre strategy but excellent risk management can still be profitable, while a trader with a great strategy but poor risk control will eventually blow their account. Consistency is what ultimately determines success in trading. Traders who constantly change their approach never build the confidence needed to trade effectively. They are always in doubt, questioning whether they should enter or exit a trade and second-guessing their decisions. This inconsistency leads to emotional trading, which causes even more mistakes. The best traders stick to their plan, execute their trades without hesitation, and trust the process. They understand that trading is a probabilities game, and as long as they follow their rules, their edge will play out over time. Instead of looking for the perfect strategy, traders should focus on mastering their mindset, refining their execution, and improving their ability to adapt to different market conditions. Success in trading comes not from finding a magic formula, but from developing the patience, discipline, and consistency needed to trade effectively. The traders who succeed are not the ones who have the best strategy, but the ones who can follow their plan, manage risk properly, and stay in the game long enough to let their edge work in their favor. Many traders fail because they do not treat trading like a business. Instead, they approach it as a hobby, a game, or a way to get rich quickly. They focus on making money rather than developing a structured and disciplined approach. Professional traders, on the other hand, understand that trading is a business that requires planning, management, and constant evaluation. They follow a systematic process, track their performance, and continuously improve their strategies, just as any successful business owner would. One of the biggest mistakes traders make is not having a solid trading plan. Just like a business needs a business plan, a trader needs a well-defined strategy that outlines entry and exit rules, risk management, position sizing, and performance tracking. Without a structured plan, traders rely on guesswork and emotions, leading to inconsistent results. A trading plan provides a roadmap that helps traders stay disciplined, follow their strategy, and make rational decisions instead of impulsive ones. Risk management is another crucial aspect of treating trading like a business. No successful business takes unnecessary risks that could wipe out all of its capital. Yet many traders do just that. They risk too much on a single trade, hoping for a big win rather than focusing on long-term profitability. Professional traders manage risk by using proper position sizing, setting stop losses, and ensuring that no single trade can significantly impact their overall capital. They focus on protecting their downside so they can continue operating over the long run. Record keeping and performance analysis are essential components of a trading business. Successful traders track every trade they take, noting the reasons behind their decisions, the outcomes, and any mistakes they made. By keeping a trading journal, they can analyze patterns, identify weaknesses, and make data-driven improvements. Many traders fail because they do not review their performance and continue making the same mistakes. Businesses analyze financial reports to optimize their operations, and traders must do the same to refine their strategy. Consistency is a defining factor in whether a trader succeeds or fails. A business does not rely on one lucky sale to survive. It builds a sustainable model that generates consistent revenue over time. Similarly, traders must focus on executing their strategy consistently rather than trying to hit home runs with every trade. Those who constantly change their approach, take random trades, or chase the market without a structured plan end up losing money in the long run. Professional traders trust their edge and stick to their process, knowing that long-term success comes from steady execution rather than short-term luck. Emotional discipline is another key factor in running a trading business. Many traders let emotions control their decisions, leading to impulsive trading and poor risk management. A business owner does not let emotions dictate pricing, hiring, or investments. They make logical decisions based on data and strategy. Likewise, successful traders detach themselves emotionally from individual trades and focus on following their plan. They accept losses as a normal part of the business and do not let them impact their ability to execute the next trade properly. Investing in education and improvement is what keeps businesses competitive, and the same applies to trading. Many traders expect to succeed without putting in the effort to learn and improve. Professional traders treat trading as an ongoing learning process, continuously studying market trends, refining their strategies, and adapting to changing conditions. They invest time in self-development, whether through courses, mentorship, or market analysis, to stay ahead of the competition. Those who refuse to learn and evolve often find themselves struggling when market conditions shift. Traders who approach trading as a structured business are the ones who achieve long-term profitability. They follow a plan, manage risk effectively, track their performance, and make logical decisions rather than emotional ones. Instead of gambling on trades, they focus on steady growth and continuous improvement. Those who fail to treat trading like a business, however, continue to struggle with inconsistency, emotional decision-making, and ultimately losing their capital. The difference between failure and success lies in mindset, discipline, and the ability to operate trading with the same professionalism as any other business venture. Many traders fail because they do not develop their own trading style and instead try to copy others. They watch successful traders follow their trades blindly and hope for the same results without fully understanding the reasoning behind those decisions. This approach leads to frustration and inconsistency because every trader has different risk tolerance, emotional responses, and levels of experience. Successful traders recognize that while learning from others is valuable, true success comes from developing a unique trading style that aligns with their personality, strengths, and weaknesses. One of the biggest problems with copying other traders is that it removes the learning process. When traders simply follow signals or replicate strategies without understanding the underlying market dynamics, they fail to develop the skills needed to adapt to changing conditions. Markets are unpredictable, and strategies that work for one person may not work for another. Without a deep understanding of why trades are being taken, traders find themselves lost when conditions shift, or when their copied strategy stops producing results. Those who take the time to develop their own style, however, build confidence in their decisions and are better equipped to handle different market environments. Risk tolerance varies greatly between traders, and what works for one person may not be suitable for another. Some traders are comfortable taking larger risks for bigger rewards, while others prefer a conservative approach with smaller, more consistent gains. When traders attempt to follow someone else's strategy without considering their own risk appetite, they often find themselves uncomfortable with their trades. This discomfort leads to emotional decision-making, such as exiting trades too early out of fear or holding onto losses for too long in the hope of recovery. A personalized trading style ensures that traders operate within their comfort zone, making it easier to stay disciplined and follow their plan. Emotional control plays a major role in trading success, and every trader reacts differently to wins and losses. Some traders can handle multiple losses without being affected, while others become frustrated and start making irrational decisions. Copying another trader's style does not account for personal emotional tendencies, which often leads to poor execution. A trading strategy should be designed to complement a trader's emotional strengths and minimize weaknesses. By developing their own approach, traders create a system that allows them to stay composed under pressure and make rational decisions based on logic rather than emotion. A lack of personal ownership in trading decisions also creates problems. When traders blindly follow others, they tend to blame external factors when things go wrong, instead of taking responsibility. This prevents them from learning and improving because they never analyze their mistakes. Successful traders take full responsibility for their actions, whether they win or lose. They review their trades, identify areas for improvement, and continuously refine their approach. By developing their own trading style, they gain a deeper understanding of their strengths and weaknesses, allowing them to make necessary adjustments over time. Adaptability is another crucial factor in trading success. Markets are constantly evolving, and rigidly sticking to someone else's strategy without understanding it makes it difficult to adapt. Traders who develop their own approach have the flexibility to adjust their strategy when needed. They can recognize when market conditions have changed and make informed decisions rather than relying on outdated methods. This adaptability gives them a long-term edge, whereas those who blindly follow others often struggle when their copied strategy stops working. Developing a personalized trading style requires patience, self-reflection, and continuous learning. It involves experimenting with different strategies, analyzing performance, and making adjustments based on what works best. The most successful traders take inspiration from others, but ultimately refine their approach to suit their unique personality and goals. Those who fail to develop their own style remain dependent on external sources, making them vulnerable to uncertainty and market changes. The key to long-term success lies in understanding oneself, building confidence in personal decisions, and creating a strategy that fits individual strengths and weaknesses. Many traders fail because they focus too much on short-term results rather than building a long-term process. They become obsessed with making quick money, constantly checking their profits and losses, and reacting emotionally to every trade. This short-sighted approach leads to inconsistent decision-making, overtrading, and ultimately blowing up their accounts. Successful traders, on the other hand, understand that trading is a long-term game. They focus on executing their strategy with discipline, managing risk, and letting their edge play out over time rather than chasing immediate gains. One of the most common mistakes among struggling traders is measuring success based on individual trades rather than overall performance. When traders judge their ability based on whether a single trade was a win or a loss, they become emotionally attached to every outcome. This causes them to feel overly confident after a winning trade or frustrated after a losing one, leading to impulsive decisions. Professional traders, however, understand that no single trade matters in the grand scheme of things. They evaluate their success over a large sample size, ensuring that they consistently execute their strategy rather than focusing on short-term fluctuations. Short-term thinking also causes traders to abandon their strategy too quickly. Many traders start with a well-defined approach, but lose patience when they experience a few losses in a row. Instead of sticking with their plan and allowing probabilities to play out, they change their strategy, tweak their indicators, or look for new setups. This constant switching prevents them from ever mastering a single method. The best traders understand that all strategies go through winning and losing periods, and the key to success is sticking to a proven plan through both good times and bad. Overtrading is another consequence of focusing on short-term results. Traders who try to make quick money often take too many trades, believing that more trades will lead to more profits. They chase the market, enter low-quality setups, and ignore their risk management rules. This approach increases transaction costs, exposes them to unnecessary risks, and leads to burnout. Professional traders take a different approach. By only trading high-probability setups that align with their plan, they are patient, waiting for the best opportunities instead of forcing trades out of desperation or boredom. Emotional trading is a direct result of failing to focus on the long-term process. Traders who obsess over short-term gains become fearful when they see red on their screen and greedy when they see profits. They cut winning trades too early out of fear of losing money and hold on to losing trades too long, hoping the market will turn in their favor. These emotional reactions sabotage their success and prevent them from executing their plan consistently. The most successful traders remain emotionally detached, treating trading as a business rather than a gamble. They follow the rules without letting emotions interfere with their decisions. Another critical aspect of long-term success is proper risk management. Traders with a short-term mindset often risk too much on a single trade, trying to make quick gains. This reckless approach can lead to devastating losses that wipe out their accounts. Professional traders prioritize risk management above everything else. They risk only a small percentage of their capital per trade, ensuring that no single loss can significantly impact their overall performance. This allows them to survive losing streaks and continue trading over the long run. The key to becoming a consistently profitable trader is shifting from a short-term mindset to a long-term perspective. Instead of focusing on individual trades, traders must look at their overall process, execution, and risk management. They must develop patience, trust their strategy, and remain disciplined even when the market tests them. Those who fail to make this shift will always struggle with inconsistency, emotional decision-making, and account blow-ups. Those who embrace the long-term process, however, will build a sustainable trading career based on consistency, discipline, and calculated risk-taking. Many traders fail because they do not understand the importance of psychological resilience in trading. They focus entirely on technical strategies, indicators, and market analysis while ignoring the mental aspect that ultimately determines long-term success. Trading is a highly emotional activity that tests a person's ability to remain disciplined, control fear and greed, and stay rational under pressure. Without psychological resilience, traders fall into self-destructive habits such as revenge trading, overtrading, and abandoning their strategy after a few losses. The ability to manage emotions, stay focused, and maintain confidence through winning and losing streaks is what separates successful traders from those who fail. One of the biggest psychological challenges traders face is dealing with losses. No matter how skilled a trader is, losses are inevitable. Many traders struggle to accept this reality and take losses personally, viewing them as failures rather than as a normal part of the process. This leads to emotional reactions such as chasing the market to recover losses, increasing position sizes impulsively, or exiting trades too early out of fear. Successful traders, however, understand that losses are simply the cost of doing business. They do not allow a single losing trade or even a series of losses to shake their confidence. Instead, they focus on executing their strategy consistently, knowing that their edge will play out over time. Greed is another psychological trap that causes traders to make poor decisions. When traders experience a few wins, they often become overconfident and start taking excessive risks. They increase their position sizes, abandon risk management rules, or take impulsive trades based on excitement rather than logic. This overconfidence eventually leads to significant losses when the market moves against them. Professional traders remain level-headed after wins, knowing that no streak lasts forever. They stick to their risk management plan, never letting emotions dictate their decisions, and maintain a balanced mindset regardless of short-term success or failure. Fear also plays a significant role in trading mistakes. Traders who have experienced previous losses often hesitate to enter trades, second-guess their analysis, or exit winning trades too early to lock in small profits. This fear prevents them from following their strategy properly, leading to missed opportunities and inconsistent results. The most successful traders recognize fear as a natural emotion but do not let it control their actions. They trust their process, take trades based on their plan rather than emotions, and accept that losses are part of the game. By maintaining emotional control, they are able to execute their trades with confidence and discipline. Revenge trading is another common psychological pitfall. When traders suffer a big loss, they often feel an urgent need to make the money back quickly. This desperation leads them to take reckless trades without proper analysis, often resulting in even more losses. This cycle of emotional decision-making can quickly destroy a trader's account. Successful traders avoid revenge trading by accepting losses without emotional attachment. They take breaks when needed, reset their mindset, and return to the market only when they are thinking clearly and following their strategy. Developing resilience in trading requires self-awareness and mental discipline. Traders must learn to detach their emotions from their trading decisions and focus on long-term consistency rather than short-term outcomes. Keeping a trading journal helps identify emotional patterns and allows traders to recognize when they are making decisions based on fear, greed, or frustration. Implementing mindfulness techniques, such as meditation or deep breathing exercises, can also help traders stay calm under pressure and make rational decisions. Psychological resilience is what enables traders to endure the ups and downs of the market without losing confidence or discipline. Those who fail to develop this mental strength will always struggle with emotional decision-making, leading to inconsistent results and eventual failure. Those who cultivate resilience, however, build a strong foundation for long-term success by maintaining focus, managing emotions effectively, and executing their strategy with discipline regardless of market conditions.